What if investing could be so simplified? All you had to do was put money into one ETF, set it and forget it with constant contributions. You could go ahead and grow this portfolio into millions of dollars. That's exactly what we're going to be looking at in today's video. The S&P 500 and why people have said you should own it in its entirety, and why could this one ETF be the way to get those millions of dollars. Now, when we think of investors like Warren Buffett, he said everyone should own the S&P 500, but what exactly is the S&P 500 and what does that mean? So when we think of the S&P 500, this is roughly the 500 leading US companies created in 1957. The S&P or Standard & Poor's 500 was the first stock index weighted by market capitalization. That is something very important to note that we'll look at in just a minute, because depending on the size of the company, it is going to have a much heavier market weight, which means when we start getting these mega companies, these huge artificial intelligence, these tech companies, they're holding a bigger portion than some other companies. And of course, the S&P 500 makes up 80% of the total US stock market, which is huge. Putting money into this S&P 500 gives you instant diversification. Currently holding 504 on different companies, different holdings within the S&P 500 index, which means you're invested into every sector that we have out there. Now, when you think of the S&P 500, some of those big companies, we're talking about Apple, Microsoft, Amazon, Tesla, Visa, Home Depot, Coca-Cola, Walmart, McDonald's. When you start looking around your house and household goods, majority of stuff that you see is coming from those companies that are within the S&P 500. But why exactly and how do you invest in it? Let's go ahead and take a look at my favorite ETF. And as you can see here, this is one that I do personally hold in my portfolio, and I hold it in a really big weight. This is the VOO, or the Vanguard S&P 500 ETF. Now again, this is one simple ETF, and thinking big picture as we go through this, investing in this one ETF would make a really, really big difference. Now, of course, we have the fact sheet. The VOO is the ticker symbol on this, but when you start looking at the year-to-date returns, it is 19.37%. Year-to-date returns, even with the NAV right here, 19.5. So we are seeing north of a 19% return. When you start putting this in perspective to high yield savings that are offering 5%, CDs that are offering 5.5%, the S&P 500 this year particularly has been on fire. This, of course, driven by those mega cap stocks, those big Apple, the Nvidias, everything that is held in this portfolio, which we'll kind of break down, is on fire with artificial intelligence. And if you think, and this is a good way to look at it in a way that I kind of pose it, is when you start looking at something like the VOO in the next 3, 5, even 10 years, do you think we're going to be utilizing artificial intelligence a lot more than we are today? Chances are that answer is probably yes. Do you feel that we're going to be a lot more reliant on technology, on computing software, on cloud computing, on some of the really big things that are driving some of these larger companies? The answer for me in that scenario is yes again, which is the reason why this is such a very good investment. Now, when you think of the VOO, the Vanguard S&P 500 ETF, this tracks the index that we were just talking about, that Standard & Poor's index. So this is mirroring the actual Standard & Poor's index, that S&P 500, with what they're holding in here, with the weight, with the distribution, everything else. Now, of course, when it comes to the ratios and when it comes to expenses, this is one that is very, very low. I know it is a 0.03, which means when you look at the expense ratio, most financial advisors charge about 1%, maybe 1.5%. If you put everything in here, you're paying a 0.03, which is almost nothing when it comes to the comparison. So looking at the total returns, this is where it does get really interesting. So looking at a month, 1.2, which is actually right down here. 3 months, we're already up 10%. This year, as you can see, year to date right here, 16.58. Now, of course, that is a very, very big growth factor. And all years are not up years. Even looking at 2022, it was a down year, and it was down a lot when it comes to the S&P 500. But then when you start looking at a year, we're at 22. Of course, 3 and 5 year kind of indicative of how the market has been trending. But what we want to look at is over the last 14 years since inception, which of course was 9/7/2010. So coming up on 14-year anniversary of this specific ETF, we're yielding a 14.51% return. So 14.5% over 14 years. When you start thinking about that growth factor, when you start doing contributions and adding money in here, even if you started with a larger nest egg in this, and if you kept it here for the 14 years, you would see a 14.51% return, which is incredible when you start thinking of compounding. Now, of course, the expense ratio, like I said, is a 0.03. Very, very dismal for the expense ratio, which is perfect. When the average expense ratio is 0.78, I mean, you're talking what, 20x what it is for the VOO. Kind of crazy to think how effective this really is. Then, of course, the benchmark is the S&P 500, which is, again, this is considered the beta or the 1.0. This is the deviation from where they are. It is spot on because it does track that S&P, that Standard & Poor's 500. Now, when you start looking at the price really doesn't make a big difference because you can buy this in fractional shares with M1 Finance. You can do it with Robinhood. You can do it with a lot of different places. So even here, I don't need $518 to go ahead and invest in a share. You can put 50 bucks in there. You can put 100 bucks in there. It will buy fractional shares of this, which makes a big difference for people who don't have a ton of money to start investing. But it also makes a difference. Let's say you're putting $100 away a month and you're putting it in there. You're putting your $1,200 a year. This is going to snowball. This is going to build when it comes to the portfolio. And of course, you can kind of look at the data, the analytics, the 52-week high where the low was. Kind of crazy to see the variance. But remember, we are not looking week to week. We are not looking month to month. We are looking, 5 years at a time. We are looking decade to decade. Even now before retirement, I have another 20 years. If we have another 20 years with the VOO that even yields, a 10 to 14%, that is going to be incredible. But when you start looking, since we started the Standard & Poor, which I believe was in 57, it has yielded about 11%. Even there, the growth factor just for that S&P 500 is phenomenal at 11%. Anything north of 10%, I will absolutely take it. Now, when we start looking at the portfolio, like we said earlier, 504 different stocks make this up. And you'll notice the investment style, which of course is by Vanguard. It is a large cap. It is a blend. So we know Warren Buffett looks for a lot of value. We know a lot of people look for growth with like the VUG or the QQQM, a lot of those big tech stocks. This puts it in the middle. That is the reason why I love this, is the instant diversification. Again, it's not really overvalued because you have a lot of companies that are doing incredibly well. And of course, if you do have companies that are underperforming, that's okay because we're taking the net average of those 504 different companies. There might be some losers. There's a lot of winners in there. And I believe at this point, it's about $13 billion, if I remember correctly, 13.8, $14 billion to even rank in the S&P 500, the top 500 companies in the United States. So we are talking large companies of about $14 billion, which is kind of crazy. Earnings growth rate, 17.9. So doing pretty solid there. Now, of course, risk associated, do your research. Do your research on everything that you're really investing in. But this is where I do like the breakdown as well. And you'll notice the biggest chunk in here is information technology, IT 31.4%. This, of course, is by the market cap. That, again, is something that we talked about earlier, something that is very important when it comes to the market cap in here, because the information technology, the Apple, the Google, the NVIDIA, those companies are so large, they're taking up a bigger chunk. There are different ways to invest in the S&P 500. You can actually do it by the companies themselves, but you'll notice with a lot more weight in these technology companies, it gives you a lot of room for growth, but you're still getting a lot of stability when it comes to financials and energy, when it comes to even communications, consumer discretionary, staples. You're getting a lot of diversification out of here. Even though you have a lot in this information technology, you are still spread out across the entire sector that we do have there. And then, of course, when we start looking at the actual details, again, Apple, Microsoft, NVIDIA, Amazon, Facebook, we can see that all of these larger companies do have a big percentage of the fund, which is that tech portfolio, but it is kind of leveled out as well. When you look here, what, 6, 8, 18, 19. So even NVIDIA, Microsoft, Apple make up roughly a little less than 20% of the total holdings in here, which again, by market cap, they are the largest companies. You're talking what, 83, what's that, $83 trillion? No, maybe that's, math might be a little bit off on the commas in there, but these are the largest companies. And even when you look, I mean, if NVIDIA is coming in at 74, Amazon's coming at 44, they're almost double the size. I mean, they're getting there, they're getting closer, and they're going and growing a lot faster than we see. So what does it look like on the compounding aspect? Let's go ahead and take a look at that. Now, this is another tool that I use, investor.gov. This, of course, is the compounding interest calculator. So when we think of an investment, and let's say we're just putting, let's say $10,000 in there right now. So there we go. So we got our $10,000 in there. Monthly contributions, we're not going to put anything in there. We set it and forget it. We put our $10,000 in there. And length of years right now, I have 20 years until I'm 65 years old doing and getting that retirement. So we're at 14.51. Was the percentage up or down? We'll say maybe 2%. That way we put in a little bit variance if it does really well, but we're looking at the averages. And even if we put in, let's say conservative, let's say a 10% growth with a little bit of variance up and down, then when we calculate this, that gives us $67,000 right there. So on a 10K investment, again, that compounding interest, we're putting and getting 67K out of this, totally leaving it alone. That is not putting another penny in it. That is just the growth factor, the compounding factor. And of course, depending if we're above the variance or below the variance, you can see from 96 to 46, depending exactly where we are. Now, it gets interesting when you start making your monthly contributions, because let's say, for instance, we start off with that $100 that we're putting in every single month for our contribution, 67K over 20 years, suddenly goes to 136K. So we're over double where we are. Again, the compounding factor is putting it in. Now, if we start off earlier and we're putting in that 15% of our income, and again, thinking of someone who is younger, 18 years old, they're a new investor, they have absolutely nothing, but they want to start doing the contribution and they want to put, let's say, $200 a month away. This is where it kind of gets crazy. Is the earlier that you invest, the more you're going to have. And when we start looking at, let's say 40 years, for instance, because if you're starting at 18, let's say 20, even let's say 25, so the 25 to the 40 years puts you at 65. So those are your working years. At retirement, you are just putting that $200 away. Boom. When you start looking at that, initial investment was nothing. We started off, we got out of college, 25, we started investing. That gives you $1 million. Right off the bat, $200. Now, of course, when you start thinking of really over 40 years, over your entire working life, let's say instead of $200, you start off early, you start putting that $200 away, even $100, and then we take the average. So the average over those 40 years, let's say your contribution on average is about 500, which again, there's going to be later years where you're higher up in a company, you're getting a bigger salary, you're getting more of an income, you have the ability to continue. Now, when you think of really scaling, so if I start a new job and I'm putting away that 15% and I'm 18 years old, 20, 25, when you start your career, you do that 15%. Through the next 40 years, getting raises, getting promotions, getting everything else, if you stick with that 15%, it is going to be crazy with how much money you see comes out of this, because if we're looking at averages, just looking, the salary is roughly 67K. When we think of the contributions, when we think of the matches, everything else, all of a sudden your 1 million goes to 4 million, and very, very fast when you have $4 million for retirement. This is a fun tool to go ahead and really play around with and see exactly where you get and what it looks like. Because again, $800 at age 25, that is a ton of money. When you're starting off, let's say you start a new job, you're making 25, 30K a year, doing pretty well. All of a sudden, you fast forward 20 years. Now you're, instead of making that 25, 30K a year, now you're making 80 to 100K a year. Boom, monthly contributions can definitely get there. And this also doesn't include the company match, where if you're putting in, let's say 10% or your regular 15%, which is the ultimate goal. Once we get to that 15%, we can keep that 15% contribution in there and really run it for the long term, making a big, big difference. And of course, again, company matches, a couple other things. Numbers are really just an estimation, and that's exactly why it is just an estimation range on how much you're putting in there and where you're at. So for instance, right now, I'm at about 400,000 is where we're at. I am putting in, and I know it's kind of crazy, around 2,600 a month. But thinking of the numbers, and I have 20 years until I'm in 65. If I stay with exactly what I have now, we're looking at $4.5 million is where we're going to be sitting if I work in my entirety, all the way to the point of being 65. This is where we are now. Of course, This is only my 401k that we have in the VOO. It is in the large cap. But looking at this, if we stay around that 10%, this also doesn't include everything we have for the kids, doesn't include, the independent investing I'm doing, as well as what my wife has for an investment account. So it's kind of impressive to see, again, where those numbers can be and where you can really get them to with the compounding growth. So even looking here, when we look at our contributions, so contributions, they don't come in very high when it comes into the contributions. And let me see, because if I take out, I was trying to think exactly how to do this, because the initial investment with the contributions, but if we just did the contributions, I don't think it breaks it down that far because of the variance on what exactly was contributions and what was initially what we did have. I thought for some reason that it did break it down somewhere on a table, maybe. There we go. So it shows the variance again, but contributions, of course, make a big difference. Because even if you're starting with nothing out for those 20 years, contributions right here are roughly 1.7, almost $1.8 million just from the regular contributions into those investment accounts. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.